Okay, everybody. Firstly, I would like to thank you and welcome you all to today's event. My name's Alex Herb and I'm one of the senior partners at Holborn. Today we have a very informative webinar from Canaccord. Now, Canaccord are one of the leading asset managers and we have an excellent track record and we are very proud to be one of their partners. I'd like to introduce a couple of people. First person I'm going to be introducing is Richard Burden. Richard is the Business Development Director at Canaccord. And we will also be hearing from Justin Oliver today, who's the Deputy Chief Investment Officer. Richard, over to you. If I could just remind you all to keep your microphones muted and your videos off so that we don't have any connection problems. Richard, over to you.
Thank you, Alex. I'd like to take this opportunity to thank you all for your attendance on this call today and hope that you find the information useful and informative. Canaccord Genuity Wealth Management specialise in managing people's investments. We are aiming to be the outsourced investment home of choice in our core markets. The process that my colleague Justin Oliver will run through this morning is a glimpse of the investment oversight and philosophy that underpins the portfolios that we offer. Canaccord Genuity Wealth Management currently manages over 27 billion sterling of assets on behalf of individual clients and institutions. I'm now delighted to hand over to our Deputy CIO, Justin Oliver, to present on the implications of the coronavirus and what next for markets.
Okay, thank you, Rich. Hopefully you can hear me okay.
Yeah, perfect.
Yeah, good morning, everyone. I've just started my camera there, hopefully, just so you can see there's actually someone is at the end of this conference call. I'll switch it off as we're going through, just again to make sure that we've got no, technological issues with bandwidth or anything like that. But I'll open it up again when we go through some Q&A at the end. So, yeah, as Alex and Rich have said, thanks very much for taking the time to listen today. There's a lot that we could potentially talk about in terms of the coronavirus crisis, as we've termed it. In fact, it's almost too much to get through in sort of half an hour. But what I thought we would do this afternoon is we'll make some sort of comments on the coronavirus generally and how that's evolving in terms of the latest data. Perhaps then we'll take a look at the state of the global economy, and then we've got some observations on policymakers and their response to the crisis, and then potentially what stock markets may or may not be discounting at present. Then I thought perhaps, because again a lot of the news that is coming out of the media and financial markets does seem to be a bit doom and gloom. It's not all doom and gloom. There are some positives that we can take out of the situation. So what I would also like to do is just take 5 minutes or so just to talk about some of the areas that we're looking at from an investment perspective, and perhaps some of the investment opportunities which will be presented in due course, and then we'll kind of wrap it up with just the key questions. As I've mentioned, there have been some questions which have come in ahead of time, which is great. Thank you so much for putting those through. I'll try to answer some of them as we're going through the presentation. The others which I don't get a chance to touch upon, again, at the end, I'll try and make some comments in terms of those other sort of questions. So actually, in terms of this presentation, it's been quite, I'd say, challenging to put it together because, again, there's so much information has come out and really things have been changing so quickly. So again, I just wanted to make sure that we kind of cover what I think are the main points in terms of the current financial markets, environment for financial markets. I also want to make the point that obviously when I'm talking about these sort of issues, we're talking about financial markets and in economies in quite a sort of dispassionate and sort of objective way. Please don't think for 1 second that doesn't mean our investment teams are sort of insensitive to kind of the very real impact of the coronavirus on really sort of families and societies across the world. So one of the slides I'll show you later on is about the number of unemployed people in the US, which has spiked to 22 million. Now you want to say 22 million, but that's millions of people in the US who have suddenly found themselves without a job. And obviously we have seen the use of food banks, etc., increase significantly over the past few weeks. And certainly we're not insensitive to that. And I think actually if there's one thing that we can take it as a positive from the current situation is that, again, we sort of know actually the world in a way seems to have become a little bit of a kind of place. Everyone seems to be a lot more concerned with how everyone's getting on. We're seeing it in terms of the UK of people helping the elderly with their shopping, etc. So again, if there's something positive we can take out of this, I think it's the fact that there does seem to be a bit of a sea change in terms of just the general mood and people being just that little bit nicer and kinder to their neighbours, which is good to see. So hopefully again you can see in front of you a chart. So what we'll do is start by covering the background. Where are we at the moment? And clearly, as you will be aware, we very, very quickly entered a bear market. That in itself isn't unusual. Unfortunately, bear markets do happen from time to time. But what really set this episode apart was the speed with which the bear market took hold. So again, what we've done here is just plot various bear markets in this case in terms of the US over, well, since the 1960s. So 100 marks effectively the peak of the market prior to the bear market, and along the x-axis we've got the number of trading days. So we just tried to standardize everything as much as we could. You can see the 2020 situation is at the left-hand side of the chart. So what that shows is that actually the response from equity markets on this occasion was so quick that it far surpassed anything else that we've ever seen. So when you're looking back in history, normally a transition from a sort of bull market to a bear market takes around about 10 months. This time it took 16 trading days. In 16 days, markets had fallen over 20%. Even going back to 1929, which we haven't showed on this particular chart, it took 44 days for the market to register a 20% decline, and that was during a Great Recession. So again, it just shows the speed of the reaction by equity markets. So from our perspective, again, trading when markets are moving by anything up to sort of 12% in a day is clearly sort of fraught with danger. But actually, since that sort of March 23rd low, again, markets have rebounded significantly, and certainly back about halfway up to the losses which they first incurred. So clearly, I think the question we're asking, and that everyone is asking, is, well, is that it? Have we seen the worst? I think when we're looking back at sort of economic history and the history of financial markets, it would be very unusual if we didn't get another setback of some description. Now, whether it gets us back to that sort of short-term trough in markets, and again, is open to debate. But it's very infrequently have we ever seen just one short, sharp sell-off, which is then followed by a sharp rebound, and then it's all over. Typically, there's a period of new lows being made in equity markets. So here we've just again put the returns from various assets during 2020. Again, what we can see from this is that there were very few places to hide during the sell-off. Actually, most assets remain firmly in negative territory for the year to date. Now, on the right-hand side, we've got gold and government bonds, which, again, as you would expect, have been the sort of safe havens in these times of trouble. For us as an investment house, we've had exposure to gold, not necessarily US Treasury bonds, because we didn't necessarily feel they were offering good value. Actually, we liked gold and still do, because we think it was attractive in its own right at the time. So we've had support offered by central bank buying, potential dollar weakness. And really, again, you hold gold to be a sort of hedge against general economic and financial risks. At the other end of the spectrum, again, we've seen oil prices have been effectively decimated by a number of things. Obviously, the Saudi Arabia and Russia, OPEC plus spat has made a big difference. We've seen over the past couple of days the very, very bizarre situation of the WTI futures market actually being in negative territory. So we had negative oil prices in some of the futures markets. So that's been potentially the worst place to be. Actually, again, when we're looking at it from our perspective of managing client portfolios, I think we're pleased. Actually, some of the themes that we've had within our portfolios and funds for a number of years, and again, I've spoken to people at Holborn about them, probably to the extent they're quite sick of me talking about things like healthcare and technology. Again, they've done very, very well in sort of relative terms, and have held up in the market sell-off. Again, that maybe comes through in terms of this slide a little bit more sort of clearly. So what we've done here is just break down the various sector returns, in this case from the S&P. And again, you can see on the right-hand side, the best performing areas. We've got tech there, which since the end of 2018 has clearly done it extremely well. Healthcare, again, has held up very, very well during the recent sell-off. And then some of these consumer sort of staple stocks, again, providing a little bit of protection in the market environment that we've seen. The other end of the spectrum, energy and financials have been absolutely crucified, basically, in terms of their sort of stock market performance. And again, why is that? That's kind of what this chart also shows, is that over the past 3-4 years, investors have been more focused on growth stocks. What they want is companies to deliver continued earnings growth. What they don't necessarily want, and what they haven't been attracted to, is the value areas of the market. And financials and energy have been very much played a prominent role in terms of that value part of the market. Actually, what we've seen over the past couple of months also is that high dividend yield sectors, which actually you'd normally expect to provide some sort of protection, actually haven't. And that's a reflection of the fact that, as you'll have seen, or as you may have seen, a lot of companies are under pressure to stop their dividends for a period of time, particularly in terms of the UK bank sector. And that's had quite a marked impact on the high dividend yielding areas of the market. Actually, the market has rewarded companies who have been growing their dividends, even from a slightly lower base. And that's certainly been more rewarding than outright yield. So that's where we are. Clearly, what we're interested in as an investment house is trying to find a roadmap for where we move going forward. Again, this is where we go into the general update in terms of the coronavirus. Now, clearly, there is so much information in terms of the coronavirus that it is very, very easy to be kind of overwhelmed by the data which is coming out. Certainly, I speak personally, I'm being inundated with emails talking about everything about the coronavirus crisis. I think what we need to focus on is just a few key metrics. I think it's very easy in this sort of environment to find out you're being inundated with too much information, not being able to see the wood for the trees in a way. I think the key point that we'll make from this is that clearly the coronavirus, it's still a very serious issue, and it remains a key risk to the global economy. It's a fluid situation, but really any belief that the war against the virus is being won, I think is a little bit sort of premature. So when we're looking at the numbers coming out, the pandemic continues to worsen in places like the US, Canada, Sweden and Japan. So you can see 5-day and sort of 2-week trends are still, for new cases and deaths, are still trending higher. Some improvement in places like Italy, which again has been hit very hard, Austria and Swiss. The rest of Europe's a little bit mixed. But when you're adding everything up, advanced economies are still continuing to experience something like 50,000 new cases per day. So certainly too soon to say when the suppression policies that we've seen from governments will end on a broad basis. We've got to get this crisis under control. When we're looking at, again, the world, I think the one area that really does, that we're still concerned about primarily is the US. And that partly reflects the fact that President Trump is so forthright in some of his opinions. Again, I think it's unfortunately coming a bad, well, there's never a good time to have a coronavirus crisis, but Donald Trump clearly has something else on his agenda at this moment in time, which is his re-election. And he realizes there is a big danger that if he doesn't reopen the economy quickly, then that is going to significantly hurt his re-election chances. Because the one area that he has scored consistently highly on in terms of the voters is his management of the economy. Again, when you're looking back in history, it's been the state of the economy which has a real influence in terms of whether a president gets re-elected. So actually, I think there's a real danger out there that President Trump might try to force the economy to open too quickly, which could lead to a resurgence in new cases. And actually, what's quite instructive is looking at Singapore potentially as a roadmap for what might happen in the US. Now, Singapore was initially praised very highly for their handling of the situation. They began to reopen the economy only to see the number of new daily cases spike higher again. So across the world, it is perfectly feasible that economies will slowly reopen only to have to be partially locked down again as the number of coronavirus cases increases again. I don't think we're going to be in a situation where economies are locked down one day, the next day they're fully and permanently reopened. Unfortunately, it's not going to work like that. I think we're going to have a period of rolling, partial lockdowns once this initial period is over, which will clearly crimp economic growth. So on that basis, a global recession, a global economic recession is pretty much unavoidable. However, the important points are how quickly will economies reopen, and when they do, are they going to be subject to further partial lockdowns as there are sort of periodic resurgences in a number of infections? And I think that seems to be the most likely outcome from this. So when you're looking at any economic forecasts coming out, I think we do have to treat them with the utmost caution at the moment, because a lot of it depends on how long this lockdown period persists, and how much of the various economies it will impact. So the chart on the left hand side is looking at the IMF latest estimates for what they expect to happen. And clearly they're expecting that the global economy is going to suffer its worst performance since the 1930s, and that's perfectly feasible. However, I think within that we do need to appreciate that again, this isn't going to be the 1930s. It's not necessarily going to be an economic depression, because without going too much into economic history, there were big mistakes made in the 1930s, both in terms of policymakers, increased protectionism, etc. So this isn't this isn't that sort of period, but there will be quite a bad economic shock, for the global economy. And I think we also have to brace ourselves for what are going to be some truly startling economic data released in the coming weeks. And we've already started to see these coming through. And quite frankly, it's not going to be difficult to find shocking figures. And while these shouldn't come as a surprise to markets, it is debatable at the moment whether they are fully prepared for the scale of the economic impact. So one of the most high-profile data releases we've seen recently, this is the number of Americans who have filed for unemployment. So that's touched 22 million people in the past week, in the past 4 weeks, which you can see is well above anything that we've ever experienced in recent economic history. Now, so far, many of those job losses are temporary, but if we don't see economies reopen relatively quickly, then some of those temporary layoffs will become permanent. But also, again, when the data is coming through, I think we have to realise that it's not necessarily going to be that informative for us. What they're going to do is reveal the depth of the economic pain that we're seeing. What they can't do is give a guidance on how quickly that pain will be alleviated. So if we want to see some evidence for the likelihood that the economic damage won't necessarily be alleviated quickly, then the chart on the right hand side might give us some indication of how that's going to evolve. So these are looking at Chinese PMI figures. So in broad terms, anything above 50 indicates expansion, anything below 50 indicates contraction. So you can see there, the collapse in the PMI figures for manufacturing and services in China in February during the midst of their economic lockdown, which were again to levels that we have never seen before. Actually, in a way, that was slightly positive, because there was a slight fear that the Chinese might have some massaged those figures to try and present a slightly more upbeat picture. Who knows, they might have done, but actually the depth of those sort of falls does indicate that they were relatively open in terms of revealing how much the economy has suffered. So again, we saw that bounce, and when we saw that those significant falls, then you can just about see that actually in the March figures there was a sudden bounce back above 50, and you might think, well, actually, so we're kind of back to normal then, are we? But that's not actually how the PMI figures work. All the PMI figures are showing is that the month-on-month change or inactivity. So the fact it only bounced back to effectively 52 means that the activity in March was just slightly better than we saw in February, and there wasn't a massive increase in activity again. There certainly wasn't a sharp rebound. Now again, it'd be instructive to see those figures as they evolve, but I think it would be unrealistic to suddenly expect the global economy, once all the lockdowns are past their worst, to suddenly expect the global economy to be back on track again. So those are the economic data. As I said, they're backward looking. They will be of slightly limited use in the near term, and all they're going to show is what effectively has happened. I think more important is what are policymakers doing about it, and this is where we can start to see some good news starting to come through. So policymakers in general terms have acted extremely quickly. And central banks in particular have slashed interest rates. In the case of the US, they've massively increased the size of the balance sheet, and actually that's been very, very quick and very significant monetary policy support. So comparing the situation that we've seen this year to what we saw, let's say, in the last time we had a crisis, so back in 2008. Back in 2008, it took around 68 days, I think, for Congress, from the start of the bear market, for Congress to pass the first set of legislation to re-stimulate the banking sector in terms of the troubled asset relief program. Going back on history, it's normally taken around 300 days from the start of the first 20% market correction for the US Federal Reserve to sanction the first cut in interest rates. Now, there has been no such delay this time. The Fed's massively increased the number of assets it's going to buy. Their balance sheet, which had been being reduced down to sort of just under 4 trillion, is now back up to around 6 trillion. And there are expectations that actually by the time this is all over, that the Fed's balance sheet will reach around $11 trillion. So, that's a very positive step. And the fact that policymakers have acted so quickly has helped to stabilize financial markets. And it's not the US which has been alone in doing that. So again, we've seen moves from the UK, Europe and China, amongst other central banks, all undertaking similar courses of action. And actually, in some ways, the response of the Chinese has been more restrained than other countries. But again, there will be further stimulus, which is forthcoming if it's needed. So that's on the monetary side. But actually, what's most important in this particular instance and in this crisis is the fiscal support which is being offered by governments. And again, actually, the size and spread of the size and speed of a response from governments across the world is actually unmatched in peacetime history. So if we're looking at the estimates of fiscal stimulus announced by the US, China, Japan, and Europe, that's coming to around $54 trillion at the moment, which is around 9% of combined GDP. So again, that's twice the level of support than was offered during the 2008 fiscal period. Again, it's about 2% larger as a percent of global GDP. So there's been a massive policy response. It's been meaningful, but actually it may yet have to be expanded further. And we also need to appreciate there's been a general provision of direct income to households from many developed countries, and clearly that shouldn't be underestimated. However, in a way, all that's doing is kind of plugging the gaps for households' income, for those who perhaps lost their job. What it's going to require is for economies to reopen again, really to reignite global economic growth. And all the fiscal spending that we've seen in the world is only going to have a limited impact while economies are still locked down. But when we're looking at stock markets, I mean, the biggest question is really at the moment trying to assess what has been discounted by stock markets at the moment. And arguably the sharp rebound we've seen since the middle of March kind of signifies that investors are expecting the current shutdown will persist for a relatively short period, following which there's going to be a slow but persistent economic recovery. And that may be the case, but again, when we're looking at markets, we're slightly concerned that that sanguine kind of assumption might be a bit unrealistic. So here, if we're looking at company earnings and what analysts are expecting for earnings to be in 12 months' time, it's kind of arguing that these forecasts are, they're not particularly realistic in terms of appraising the likely path of economic recovery. So, the line there is what the trading 12 months earnings per share for the S&P 500. The little orange dot is where the bottom-up analysts expect those earnings to be in 12 months' time. It's only around a 7% decline from current levels. So again, it's not like markets are estimating what the declines might be. Actually, if anything, markets have got quite a sanguine view in terms of what the ultimate impact on corporate earnings might be, and potentially that's too optimistic. Again, same sort of thing if we're looking at this on a sector by sector basis. So these are numbers which are being reported by FactSet, and looking at all the companies which are reported to the 16th of April, because clearly at the moment we're in the middle of the reporting season for the US, and it's an evolving situation. It's going to change day by day as new company earnings are released. But as things stand, FactSet are saying, or actually company earnings for the first quarter are going to be around 14.5% lower than they were last year, obviously led by declines in the financials and energy sectors. But actually, when you're looking at it, they are expecting certainly 5 sectors to be producing positive earnings growth. I think that might be a bit too optimistic, and I think also we need to appreciate that given the unprecedented nature of the crisis, there's got to be even greater uncertainty around these company earnings forecasts than usual. I think what we will see is forecast earnings proving to be slightly too optimistic, and they will continue to be revised down as we move through the year. But even if we're using those sort of forecast earnings, which actually might be a little bit too optimistic, valuations are looking expensive. So this is the 12-month forward price earnings ratio of the S&P 500. So again, how expensive by one measure is the US market? Actually, the market's trading around 21 times forward earnings at the moment in time, which is well above its average, and actually it's probably based on corporate earnings which might be too optimistic. So actually, you could argue the US stock market is potentially even more expensive than these figures show. A couple of things on the technical side. This basically just looks at the S&P 500 over time, so going back to the 1980s, and just shows how quickly markets reached kind of oversold levels or overbought levels. And the COVID-19 situation is the right-hand side. And again, it just kind of shows that actually markets sold off extremely sharply. However, the strong rebound that we've seen has meant that in very short order, the market is nowhere near as oversold as it was previously, and potentially indicates markets are being a little bit too optimistic in terms of what they might be expecting going forward. And again, a couple more technical measures. Individual investors, bulls, people who are bullish, those who are negative. Actually, people are broadly neutral in terms of their views. So again, there's not that sort of that fear and panic that there was about a month or so ago. So that's what where we go. I think if I had to sum it up, it was that things will remain challenging from an economic perspective in the coming weeks and months. Markets have rebounded very sharply in the past 2 or 3 weeks, certainly, and are probably being a little bit too over-optimistic in the short term. We're expecting economies, I think, to reopen in relatively short order, and that will go through just a standard process of economies being slowly reopened, and that will be open for business again in the not too distant future. That might be the case, but I think they're being a little bit too over-optimistic in the short term, and we wouldn't be surprised if we do see markets give back some of the ground which they've gained over the past 2 or 3 weeks. But again, that doesn't necessarily mean that we believe the bull market is over. We don't actually. We do think the bull market will resume, but we might have to go through just a little bit more pain before we get there. Because again, there's an adage about don't fight the Fed, which basically means if the Fed is trying to stimulate the economies, don't bet against them. They'll get their way. They will re-stimulate economic growth. And I think when we're looking at it, the policy support that we've seen from central banks and governments across the world will have a positive impact on certainly on financial markets. But we might have to go through a little bit more pain before we get there. But what we've been doing as an investment house is already, our attention is starting to turn to what are the investment opportunities out there? Where do we want to be positioned to potentially capitalize on those stock market rises as and when they come? Actually, there's a few areas that we're thinking about. Now, it's not to say that we'll definitely increase the allocation to these sectors, these areas, or these opportunities. All it's trying to do is highlight some of the things that we are actively considering at this moment in time. So when we're looking at it, actually, we're looking at the relative valuation of the US compared to other markets around the world. So we're thinking about, actually, the US is looking quite expensive. Is there other areas that we might want to look at? And certainly Europe is one such area. We've benefited from not having exposure in 2020, but at least these are at least two things which we're considering at the moment. First is that Europe, together with other regions, does trade at a more attractive valuation than the US. Secondly is that actually Europe has often been a more cyclical economy and cyclical stock market. And certainly, as and when we believe the worst of the market falls are behind us, I think there will be some attractions from the European stock market over and above the US. We talked about, I talked earlier about financials and energy. Again, when we're looking at it, there's value has not traded as cheaply relative to other factors within the market as it is doing at the moment. So financials and energy are very, very cheap. Now, it's not to say they can't get cheaper, but actually what we should be interested in is buying assets which are undervalued, with the expectation actually over time that value will be released. So value stocks in which financials and energy companies feature prominently have underperformed quality, growth, etc. by a significant margin over the past few years. One of the other areas that we've had within our portfolios for a number of years, and which we're still quite attracted to, is the healthcare sector. So again, when you were looking at the market, and when we're looking what might potentially drive healthcare stocks, really we're thinking actually there could be some secular growth trends in place, which means that healthcare is likely to remain an attractive destination moving forward. So healthcare doesn't actually trade at a premium to the market. A lot of companies there are generating a lot of free cash flow, low levels of debt, and actually that they earn quite a high return on assets and capital. So in addition, across the world, I think it almost seems inevitable that spending on healthcare is going to be increased quite significantly over the coming years, and by a significant amount in certain jurisdictions. So when you're looking on the left-hand side at the federal healthcare spending which can come through in the US, they're expecting 2020 for healthcare spending to be 26% higher than it was during 2019. And even that's slightly out of date because the latest figures kind of indicate it might be nearer sort of 30%. And when you're looking at it, there's a very close correlation between how healthcare as a sector does and that healthcare spending. So that's certainly one area which we think is quite attractive. Technology is another. I think we need to point out it's not necessarily just about the large mega caps, the Facebooks, the Amazons, the Netflixes of the world. There's a lot that goes in underneath the technology sector. There's a whole cornucopia of investment opportunities out there. The fact that I'm speaking to you today from my home study, but still working, still got contact with the markets, etc., kind of just shows that there will, I think, be a whole paradigm shift in the way people approach technology, certainly in the balance between home life and work life. So it's not just about those sort of FANG type stocks, but there will be an increasing adoption, I think, of technology and using technology to offset some of the ongoing restrictions that we might have to sort of cope with as these sort of rolling lockdowns continue to come and go in terms of economies. So really, again, this is just summarising it up, and then I'll kind of deal with some of the questions which you've kind of very kindly sent in ahead of time. Yeah, as with anything, that there's positives and negatives in terms of the whole situation. On the positive side, without a doubt, the best thing that has happened is that we have seen governments and central banks throughout the world act very quickly and act very aggressively. So that will certainly help when economies start to reopen. If you're looking at things on the technical side, actually markets are generally moving in that sort of positive direction. And actually the fact that investors still seem generally quite cautious, actually from a contrarian perspective, is a positive development. And actually so is the fact that some economies are slowly starting to reopen. They're starting to slowly reduce some of those lockdowns which are in place, because we will get through this period eventually. It's just a question, I think, of timing. On the downside, I think again it would be unrealistic to expect by at the end of this year for all that economic damage to have been undone. It might take a lot longer than that for some of the economic damage to be repaired. And at this moment in time, what we've seen from people like the US Federal Reserve, all it's doing is plugging the gaps for demand. It's not necessarily stimulating economies per se. It's just putting a bandage on the wound, effectively. What we need to see again is economies be reopened. And if that stimulus remains there, which actually I think it probably will, that's when we'll start to see, I think, economies starting to really reaccelerate again, and financial markets to perform quite well. I think we also need to just appreciate bear markets aren't, unfortunately, necessarily over in 4 weeks. In fact, certain markets like the NASDAQ is higher over 12 months, does kind of indicate that certain stock markets haven't fully appreciated the scale of what we're going through. And unfortunately, again, we have to admit, actually a second wave of infection is perfectly possible. Certainly as economies reopen, Singapore kind of gives us that guidance that perhaps the biggest danger is economies being opened too quickly. And then just a few of the key messages, which I won't necessarily go through at this moment in time, other than say, as an investment house, as an investment team, clearly, again, we're trying to meet as frequently as we feel necessary as we try and navigate our client portfolios and our funds through this. The most important thing that actually we've come to the conclusion of, as it's important all the time, is to make sure that none of the underlying investments that we've got suffer sort of permanent or lasting damage. So the fact that we can still deal on a daily basis, should we need to, the fact that we could have dealt during the times when markets were moving by 12% in a day, albeit it was challenging, the fact we could still trade in that sort of environment is certainly a positive. I think it's very impossible, it's very difficult to fully gauge some of the longer term impacts of this crisis. There will be a global recession, but the fact is that there is an ongoing policy response from central banks and governments, and that will help in the long term, maybe not so much in the short term with economies still in lockdown. With that, what I'll do is just start my video again. So say hello. Rich, can you see me there?
Yes, I can, Justin. We can see you now.
Sure.
Thank you very much for that. I'll let you have a glass of water while you move on to some of the questions. I hope everyone found that informative and useful for a kind of our snapshot of where the markets are at the moment with this awful crisis going on. And I'm going to hand over now to Justin to answer some of the questions that some of you kindly prepared for us prior to the event.
Thanks, Rich. So thanks very much for sending through some questions. I'll try and answer these relatively briefly if I can, but what I would say is if you want more detail in terms of them, just let your contact at Holborn know, and they'll pass them across to me. I'm very happy to give more detail as I can, because again, I'm conscious in the however long we've got, 5, 10, 15 minutes left, it's impossible to go into great detail in terms of some of these questions that have been put through. try and sort of sum them up, there was a question here in terms of UK property prospects, both on sort of rental value and house prices, and what the impact might be and what the scenario is for UK house prices. I think we need to appreciate, actually, the UK housing market isn't really operating, quite frankly, at the moment. Certainly some of the, there's no real market as such, clearly, because you can't go around and view housing, and certainly completions are very, very difficult at the moment. The latest indications that we've seen from the marketplace, there's a property firm called Knight Frank, who have suggested that the lockdown that we're seeing in the UK is going to result in something like 500,000 fewer house sales this year, so around 40% lower than we saw in 2019, and there's going to be something like 350,000 less mortgages approved. So in the short term, that's not necessarily going to be supportive for the UK housing market. I think when you're trying to look on a long-term basis, questions to be asked is, well, actually, may we start to see some government support coming through? I think it's entirely possible, albeit the fiscal stimulus they've got is being targeted kind of other areas at this moment in time. But it's certainly possible that once this kind of initial period has got through, there might be specific measures to try and stimulate the housing market. But again, it comes down to, I think, the length of the lockdown is going to be key as far as it's concerned. The UK property market has been somewhat in the doldrums for the past couple of years, really, because actually we had Corbyn, actually was frightening people. And then we obviously had Brexit. Those kind of fears went away temporarily, and then the COVID situation arose. So we're certainly not predicting a short-term collapse in the market, but there will be questions about distressed sellers, actually whether that unemployment that we've started to see increase. Clearly, if those temporary layoffs become permanent, then we might see housing or distressed sellers in the housing market, which will clearly act to reduce house prices. On the other side of it, you can say, actually, in that environment, maybe the demand for rental housing rather than home ownership per se might actually increase. So, it's one of those many difficult areas, or one of those areas which is very difficult to call at this moment in time, very much predicated on the length of the lockdown, but certainly on the assumption that we do get through this relatively intact. There's no reason to believe the UK housing market is going to collapse, albeit I think things like Brexit, etc., are going to keep a lid on house prices. Couple of questions in terms of interest rates and sterling. So again, keeping on that sort of UK base. Interest rates in the UK won't be going up anytime soon. I think it's one of the clearest things that we can say from this. The Bank of England, Federal Reserve, European Central Bank are going to be very, very slow and cautious in raising interest rates, and I think that's a long way ahead of us yet. I think sterling will probably be under pressure because not only is we've got the coronavirus crisis to deal with as far as the UK is concerned, but actually once this whole situation is over, we've got the dreaded Brexit word to have to cope with once again. So actually, when you're typically looking at currency movements, what you're trying to factor in is relative interest rates and relative growth differentials. Actually, the UK has got interest rates of virtually zero, but actually so is basically everyone else. And actually what's going to be impacting growth in the UK economy is pretty much what's going to be impacting other regions and economies as well, albeit you've got that extra Brexit uncertainty. Clearly negotiations are going on, but I was dubious about the fact that the negotiations would be completed by the end of the year, even before this coronavirus crisis. So I think what we have to say is the chances of actually the UK fully leaving the EU without having a full or any sort of trade deal, in fact, is higher than it was, and I know those expectations you would expect sterling to be relatively weak. Other currencies, just to very quickly talk about, the dollar tends to be counter-cyclical. So basically, as the economy is accelerating, dollar typically weakens and vice versa. Again, if we come out of this in relatively okayish economic health, you'd expect that the trend for the dollar will be downwards. In that sort of environment, the euro could be one of the better performing current of the major currencies, but again, there's a few views coming out about what does this mean for the whole European project, the EU as a whole. Clearly, the EU, one of the guiding principles of the EU is free movement of capital and labour, and actually the fact that many economies or many governments have shut their borders doesn't really help with that sort of thing. So on the expectation the EU will remain broadly as it is, then I think the euro should be relatively stable in that environment. There are a couple of questions really along the lines of when the stock market's going to get back to their sort of pre-crisis levels. Again, that's very dependent on how long this lockdown persists. The way I would phrase it is that actually the bull market isn't over. It's just taking a temporary break for a while, because we will get out of this crisis. Maybe things will be slightly different, but the fact is that we'll be coming out of this crisis with significant levels of fiscal stimulus and interest rates having been slashed to zero. As and when the economy is ready to regain momentum, stock markets should respond positively to that, albeit our major fear is that actually we might see a second leg of the sell-off. Timing that is going to be incredibly difficult. I think even we're going to struggle to time ourselves in and out of that. So having taken some defensive action earlier in the year, we're biding our time before potentially reinvesting some of the cash that we raised, potentially some of the money that we took out of gold. And we're looking already and doing some of the groundwork for those areas that we might want to invest in. So at this moment in time, tech and healthcare seem to be areas that we want to invest in and buy, albeit they're a bit too consensus in a way. Everyone seems very enamored with the whole tech and healthcare story. I think there are great fundamentals behind it, but I think we need to in the short term, because we've seen quite strong inflows into those areas. The final sort of set of questions were around inflation, disinflation, what's going to go on there, and a quick question on the gold price. I think in terms of the inflation and deflation story, when the lockdown was just about China and it was just about the supply of goods and services potentially being curtailed, then the ultimate output was likely to be inflationary, because clearly there was no, the flow of goods wasn't as operating as efficiently as it was. And again, China is still the manufacturing hub of the world. So therefore, the fact that it wasn't operating, less goods being produced, you kind of expect that to be inflationary. That was very quickly superseded by the massive demand shock that we've seen across the world, with most economies being shut down. So in the short term, there is very little doubt that the pressure is going to be more towards disinflation and deflation. Again, when we come out of this situation, if we come out of it with all guns blazing as far as interest rates and stimulus is concerned, eventually inflation will start to accelerate again. That's when we'll need to see policy or interest rates start to rise potentially. But I think, to be fair, that's quite a long way away yet. Certainly, I don't see inflation becoming a problem in the very short term. Even before we got this, there was very little inflation out there in the system. So I think those kind of deflationary tendencies will tend to prevail. But similarly, I don't think we'll get an outright deflationary environment like we saw in the 1930s. that covered all of it. There's a quick question in terms of gold prices. Yeah, ascribing a value to an asset which doesn't yield anything is very difficult. I think $1,900 an ounce is probably the level that we would be looking at to start reducing our exposure to gold, having, it's done very well for us since we held it over the past 12 months or so. Again, we're potentially using it as a source of funds, but we've also got a fair bit of cash within our portfolios and strategies at this moment in time. So we'll probably use that cash to invest in equities when we feel the time is right. And then at a later date, we might have a look at gold. But for now, it's acting as a protection within portfolios. So I wouldn't be looking to sell it very quickly, if I can put it that way. So those are the questions I received in, Rich. Alex and Rich, I don't know if any more questions have come in or if you'd like me to cover anything else.
I'm just going to thank you for that, Justin. And now I'm going to pass over to Alex because there have been a couple of questions that have come through on the group chat. Alex, over to you.
Yeah, hi, Justin. We've had a couple of questions. One is, being that markets are so low now, is it worth doubling down to return quicker?
Okay. I would be very cautious about that. I don't want to be flippant about that, but that's almost like the bet big and chase your losses view of gambling. No, as I've tried to put through, I think that ultimately, do I think that markets will be higher in 2 or 3 years than they are now? Yes, I do. Do I think that there's the possibility that markets will go lower before they move higher? Yes, I do. But again, it's kind of open to debate. The situation that we're seeing is fluid and it is dynamic. Now, if we suddenly come out with a cure to the coronavirus, in the next month or 3 months, whatever it might be, unlikely as it seems at the moment, we'll have to change our views, and we might change them quite quickly. And actually, in that sort of environment, maybe we don't see the second leg of the sell-off. It's one we have to keep an open mind on. And actually, I think that's what we're very much focused on when we're meeting as our investment committees. Is we've kind of got that view that short term, a little bit more volatility, longer term, the trend will be upwards. But we've got to keep an open mind about things. And actually, as the facts change, to use an old adage in financial markets, as the facts change, we'll be prepared to change our minds accordingly. But I wouldn't necessarily be doubling up just because if it falls, it must, it's definitely going to go up in the very short term. That's not how we would approach it. I think be comfortable with the level of equity weighting that you've got. Make sure first and foremost that the underlying investments you've got there offer you that continued liquidity, because if the situation does change, then you might want to change your asset allocation and investment portfolio around accordingly. Okay, excellent. And one that's on the lips of many people, or on the tongue of many people, oil price. The massive reduction within the oil price. What's your views on that? A good asset to be purchasing right now at the current levels? Yeah. So Alex, I remember when I was in your offices at January time, and I think I got asked that same question about oil prices. So I'm just moving back so everyone can see what's happened to oil prices. Yeah. And I like to think I'm good at my job, but oil prices are down 55% since the beginning of the year. I wouldn't have forecast that would happen, quite frankly. I don't know anyone that did, because again there was a general expectation that Saudi Arabia and Russia would strike a deal to sort of reduce output, which clearly didn't happen in the short term. I have always thought that forecasting oil prices is a bit of a mug's game. Even some of the best energy and oil analysts that I've come across over the years, and all they have to do is kind of forecast the oil price, have often been spectacularly wrong, because it's not just necessarily about supply and demand, but there's a a cartel out there. There's political pressures to either keep oil prices above a certain level, to try and help certain energy sectors, or below a certain level to try and help the consumer. I think it's a tremendously difficult asset to call consistently. When I'm looking at it, is there a reason to suddenly expect oil prices to recover from the $20 or whatever they are today up to $30 to $40? I can view that as very unlikely, not least because, again, the demand doesn't seem to be there at this moment in time. From the world is in lockdown. I can't remember the last time I drove my car, but I'm slightly fearful I might have forgotten how to drive by the time this lockdown period ends. There's not that demand from manufacturers, petrol, etc., at this moment in time. So again, it does depend on the whole demand picture, but we also know that storage facilities are full. Certainly Cushing in the US is pretty much full at this moment in time, which was partly why we saw the ridiculous situation of 2 or 3 days ago when we had negative oil prices for WTI. It was because Cushing was full, and people didn't want to have to take physical delivery of a barrel of oil because there was no room left. So you've got supply which is probably still exceeding demand at a time when you've got lots of oil out there. I struggle to see why oil prices will rise significantly, but I will say I'm not an oil expert. But I would argue that even oil experts don't get it right very often.
Okay, thank you very much, Justin. Okay, lastly, just want to thank everybody for attending today. We've just gone over the hour mark, which is great. There's been lots of information that I'm sure everybody can take in. One of the things that sticks out in my mind, a saying that Justin came out with, was don't fight the Fed. They tend to get their own way when stimulating the economy. And I think that's a really important message. So lastly, from me and from Holborn, Justin and Richard, thank you very much for putting the event together and for your presentation. As I mentioned on the group chat, everybody, if you do have any questions, don't hesitate to contact your advisor or questions@holbornassets.com, and we will endeavour to put them in front of Justin and answer them as quickly as possible. Thank you very much for your time. Hope you all have a great day.